Hi, I'm Andrew Overman of Location, and this is...
I'm Michael Webb from Mortgage Republic.
And together we work together to answer viewers' questions to navigate and negotiate the frenetic world of the mortgage market at the moment. And this week's viewers' question, Michael, is we've been covering this topic and referring to it in recent weeks. What does the term payment shock mean? And I have qualified this by saying in mortgage terms. I don't mean when you get the credit card statement through and you realize the missus has been shopping on your weekend at work. But in mortgage terms, what does the term payment shock mean, please?
So it's an official kind of term within kind of the mortgage world, and it describes the change in your payment from when you come off of your fixed or tracker rate, so that is secured, onto the standard variable rate. So what would happen is, let's say you are fixed at 1.5% and your payment is £500, and then you go onto a variable rate because you haven't remortgaged, you haven't refixed, and your interest rate goes up dramatically to say 4 or 5%, and your payment then goes to £800. It's the shock of, you were paying 500, now you've got to pay 800. And it's something that brokers should explain to clients, that is there. And it's more and more important now because rates are on the rise. So you can delay the payment shock, but it's coming at some point, in that you, like I say, let's say you're on 1.5% and you may be fixed for 5 years, but in 5 years' time, even if you refix, it could be that the best deal in the marketplace for you at the time is 2.5%, which is a large percentage jump in your interest rate. And therefore your payment is going to go up, and you need to brace yourself economically, financially, for that change. It becomes more relevant when the lower the interest rates that you secure at. Because if you do secure yourself 5 years at a very low 1% kind of interest rate, the reality is that 5 years, a lot can change, and you may not be able to resecure that. And if you have then built your lifestyle around paying £500 a month, and then all of a sudden the absolute best you can get in the market, avoiding the standard variable rate, is £800 a month, that can cause some problems for people. So yeah, that's what it relates to. Lenders factor in affordability, accounting for it, usually against a standard variable rate of about 6%.
And it's important to bear in mind, though, isn't it, that lenders build that and factor that accountability in at the time that you apply for the mortgage. What isn't factored in is the lifestyle changes. If you have taken a 5-year fixed rate, a lot can change in 5 years. If I look back several years, within 5 years, I'd gone from, being a happy-go-lucky single guy to meeting my future wife, to then having 2 children in the space of just over 6 years. So an awful lot can change, and you need to be factoring that in. I was actually at a dinner party the other evening, Michael, and one of my friends was explaining this shock, because they're in a situation where they know they are going to be moving, and they just allowed their current product to lapse, and they went on to the standard variable rate, the SVR. Now, just for other people that might be in that situation, you might be planning a move in September this year, ready for the new school term. You might not be financially ready to move right now. If you're coming to the end of a fixed rate product, or some kind of discounted rate, or attractively priced product at the moment, are there any options other than going on the SVR? Are there flexible options that are still less than the standard variable rate with no tie-ins, for example? Would there be a benefit to somebody coming to speak to you?
Yeah, there are, depending on the situations of the individuals, there are some products available in the marketplace that won't have an early repayment charge. You have to be a little bit careful with them, because a lot of them carry like a booking fee or arrangement fee up front, which you'd add to your mortgage, so you might as well have paid an early repayment charge. They kind of offset each other. But yeah, there are some no fee, no tie-in products out there that should be cheaper than the standard variable rates that people are on. But obviously, you've got to be aware of like the criteria of those lenders and make sure you fit with them. The other thing that you can look at is, if you are looking at moving, is to have a remortgage with someone who would lend you enough for your onward purchase. So look at the affordability for your onward purchase, look at who's kind of good at the time, and then you can port that mortgage and top up and carry two rates on one mortgage. This can work quite well, especially if you're at a low loan to value at the moment on your mortgage. So let's say you could secure a remortgage at 60%, but when you move, you're going to need an 85% mortgage. What you would do is you'd remortgage now on a 60% interest rate, secure that, then port it, and then you only need the top up amount on the 85% interest rate. So again, keep the math simple. You have 100,000 at the moment on 1.5%, which is 60%. And then when you move, you need 150. So you port the 100 at 1.5 and you have the 50 on 2%, for example. And therefore the aggregate interest rate is lower than having the whole 150 at the 2%.
2%, 85%.
So it's a clever way, but you do need to be talking to your broker and kind of working with that, if that makes sense, and not kind of try and do that all by yourself, because I have seen people do that and they've refixed with a lender, and then when they've come to move, that lender won't lend them enough money, and therefore you have the problem that you're going to have to pay the early repayment charge or buy a cheaper property than you wanted to.
Brilliant. And as always, you know, I'm very happy to say that we recommend our clients. We have exceptional feedback from yourself and the team there at Mortgage Republic. If you do have any mortgage related questions, please reach out to Michael at mortgagerepublic.co.uk, or head over to their website, allthews.mortgagerepublic.co.uk. I've been Andrew Overman, and
I've been Michael Webb,
and you've been watching Mortgage Matters. Tune in next week, hit the subscribe button for more information, help you navigate the minefield that can be the mortgage world. Thank you for watching.
Thank you, Andrew.